All right, good morning. Today is July 6th, 2022, and I'm back with another edition of the Wednesday live show. And hope everybody had a good 4th of July holiday. We're easing back into things here, and the market is the market's going into 4th of July, it was kind of everyone was in holiday mode, and usually the first couple of days before a 3-day weekend, people are doing stuff, so it seemed like the liquidity was low. But anyway, yesterday we had a little bit of a rally in tech stocks, and that got everybody kind of excited. And the funny thing, let me go to a chart here, the S&P. The funny thing about yesterday and even the past couple of days, right? I mean, there was kind of these little rallies or whatever. I'm trying to figure out. Well, I know, but in my mind, it kind of doesn't make sense. But I mean, when you look at this chart, right? I mean, it's pretty clear what's happening here. Pretty clear. I'm gonna go against my usual rules and just draw some stuff on this chart just to illustrate my point here. So, you got a trend line there, and you got a nice downward sloping trend line here. There we go. That's close enough. So, anyways, here's my point is, I mean, when I look at yesterday, I realized why people got excited, which we'll look at the cues in a minute, is because, some of the really beaten down tech stocks kind of look like, maybe they have a little bit of a bottoming pattern and they rallied, and the price of oil came down considerably, and I think it's like around 97 something. So price of oil below 100 bucks is kind of a big deal. But I mean, when you look at this chart, for one thing, yesterday's close was right about this level. Let me draw another line on the chart. Why not? So you look at it's not really straight. There we go. Let's see if I can make it a little straighter. Here's what I was trying to figure out why everybody was so excited yesterday is because I looked at the chart, and it's like a stock that's like dropped 80% or something and then bounces 12, and if you just yeah, if you look at CNBC and they're like such and such is up 12%, and you're like, wow, I missed the rally or what, and then you look at the chart and it's just been going straight down, right? Like so many of these stocks have been, tech stocks and momentum stocks. And so, it's hard to get excited about nominal numbers when like, and so this is kind of similar, the reality of this is that, the market's gone down, roughly 20%. It was like 23, 24% at the lows, and and maybe now it's a little bit less than 20%, but it's pretty clear here that the primary trend is still down, right? And so, yeah, this little sell this well, I don't say little, but this sort of waterfall sell-off that we had a few weeks back. I mean, that was brutal for one thing because we were in this consolidation pattern, and as I recall, I think the consensus was that it was going to break to the upside out of this consolidation pattern. Instead, we had a waterfall sell-off, and basically, we just kind of bounced off of that a little bit, and even the first bounce off of it, we retraced back, and so I don't get all the excitement yesterday, other than the fact that yes, oil's back below 100, that's positive news. Gas prices are dropping, but commodities are plunging, right? And the energy stocks, was literally like the only sector that's up year to date, it's just dropped like 25, 30% in just a very short amount of time. And the fact that oil's like so crazy volatile, I mean, these type of moves ought to make everybody nervous because it's the kind of wild gyrations that we've been seeing, in asset classes and the market and different things ought to make people nervous because it's not a normal environment at all. So we haven't really been in a normal environment for what I would call normal for a long time. But anyway, now that we're headed into summer, maybe things will settle down a little bit. Who knows? Typically in the summer, things can get really dull and boring. But anyway, it seemed to me that yesterday the sentiment really sort of shifted positive, and like I said, I look at the chart and there's not a whole lot to get too excited about. However, that doesn't mean that there is a little bit of a higher low here, right? I guess that's positive, but you look at all these spots on the chart. The initial drop at the beginning of the year, that was pretty brutal, and then caught a pretty nice bounce, and everybody thought, oh, the worst is over, temporary little sell off, straight back to new highs, and it's kind of been like that all year, right? And so even back here in May, especially in May, this rally off the low in May, a lot of I think a lot of participants thought that, okay, well, all the bad news is priced in. We've seen the lows, and you keep hearing this the phrase priced in. What's priced in? The Fed rate hikes priced in, inflation numbers, whatever, a recession. See, that's the big debate now. Are we headed for a recession? Are we in, some people are saying we're in a recession. Some are saying that we're headed for a recession. Some of these, a couple of these Wall Street firms are talking about, a recession next year, which seems kind of crazy. But so there's all these different macro things sort of floating around out there. And earnings season starts in a couple of weeks, and of course, I suppose that's going to be the big decider of what happens is what these companies say the outlook's going to look like. So it's going to be really interesting. I mean, we're definitely in interesting times, and then there's all sorts of other crazy stuff, geopolitical things, and the Fed minutes are going to come out today at 2 o'clock, and as I recall, that's going to be the minutes from their last meeting, at which time they were pretty hawkish, as I recall. And so, whether the market is pricing in 50 or 75 basis points rate hike in July, I think is going to matter. And then, like we talked about last week, the other crazy thing is that the market itself seems to, or what I see about it and what I hear from various sources is that people think that the market's already seeing past, any potential recession and seeing past all the rate hikes to where the economy is so slow that the Fed's going to have to start lowering rates again, right? And I mean, it just seems kind of crazy. I mean, obviously, they say the market is looking, 6 months or further ahead or something, but it seems kind of crazy to me that the market's looking past, the end of the rate hike cycle and, the a recession, right? I mean, that's been the big thing. Is the market pricing in a recession? Well, that's debatable too, but all this stuff about what the market's pricing in or whatever seems kind of crazy to me, because then it becomes, and then there's a lot of debate about, since the sentiment is so negative that we've already seen like peak negative sentiment, and that's also a tricky game too, because I mean, when a lot of stocks fall and get crushed and people lose a ton of money, and money, evaporates into thin air, like with crypto stuff and all that, and all these, companies that probably had no business going public, of course the sentiment's going to be bad. And so I'm sure the sentiment was pretty bad in 2008, and just probably continued to get worse. Can't remember back that far, but I mean, it's no wonder the sentiment's bad. Anyway, the indexes aren't necessarily reflecting the what's happened to a lot of individual stocks, and I can't help but think, and I've been saying this for a while, but a lot of this, a lot of what's going on reminds me of 2000 and it reminds me of the dot-com bubble of 2000. And some of these stocks, I don't see them ever going back, like coming back to the highs. And there's tons of tech stocks and momentum type tech stocks or whatever that I don't think will ever get back to the highs. But speaking of this S&P here, so you know, it's in like this little consolidation area right here, and it's trying to break out of it. And the first thing to look for would be rally back up to this high from last week. So what day was that? On 628. So or 628, 629, 630, and then there was and there's 1st of July, and then the holiday weekend right there. So these two green candles here, kind of 4th of July holiday trading. Actually, these past 3 days is consolidation area. So anyway, I mean, people are getting excited and acting like, okay, the worst of the sell-off is over, which is the same thing that the same sort of mindset that we've seen before. And yeah, hey, maybe the market is sort of due for a rally, right? Sort of due for a bounce up. The next area I would look for would be up here, right? And of course, that's a huge resistance point right there. That's a big, big, big spot of resistance because it coincides with the high from last week, right? I mean, before you can get too excited, the market needs to take out that, and it breaks its trend line. And so, anything below 4,000 is still a pretty rough market. And the other thing is the sector rotation too, right? So most of the people I see on CNBC, they just bring on a constant parade of, I guess money managers that they see a lot of value in some of the beaten down stocks, and they pick and choose. But what you don't, the backstory is that they've probably liked and held these same stocks since the highs. And so let's take a look at let's take a look at the Qs real quick just to see where they're at. It's the same sort of story, right? You had a massive sell down of around 30% or whatever, and a bounce, and then a retracement, and it's trying to work on another little bounce here. Pretty anemic in the big scheme of things. Same thing here. You draw a trend line. Whoops, I forgot about this little change here. So yeah, hey, maybe the Nasdaq, or I should say the Nasdaq 100, because they're a little bit different, but the Nasdaq 100 is going to break that trend line just by virtue of time trading sideways for I mean, unless it just drops. But this trend line, and that's the thing about really super steep trend lines, but same thing here. There's tons of resistance. If I straighten this out, Nasdaq's caught a little bit of a bigger bounce, as you can see, because it's back sort of up into this area with that waterfall sell-off we had. But same sort of thing here. There's a pretty big level of overhead resistance, say at 300 on the Qs, right around 300. So S&P, anything below 4,000 is well, put it this way. The S&P needs to get over 4,000 to be constructive and sort of on the way back, and The Q's are going to need to get above 300, but there's just all sorts of resistance levels going back up. And so nothing to get too excited about yet. Look at the Dow ETF here. Yeah, the Dow's got a whole kind of a different looking pattern than both of them. But same sort of thing. Huge waterfall sort of sell-off, a bounce, and then basically in all these indexes until until they can get back above, and that probably takes some time, but I can sort of visualize. Look at the Russell. I can sort of visualize. You got like excuse me, this little cup here off of these lows, and you got a little bit of a cup sort of starting to form here, and you do have a little bit of higher low. And so here's the thing, though. Let me go back to the S&P. There's a couple other things. About this. One is that you got, in theory, you got a little bit of, kind of a bear flag forming here, right? A little bit of a bear flag, and if I duplicated that line and put it there, well, I guess as long as I'm drawing on the charts, whoops, there we go. Not the most constructive pattern, I should say. This is actually kind of fun. So, like the old days when I used to mark up the charts and draw all kinds of stuff. It's a little more tedious here. But it is what it is anyway. So, for what, like I said, when I look at this chart here, there's nothing about yesterday that really gets me all that excited, other than some of the, some of the positive things that they're pointing to, I guess, is the fact that oil is back below 100, right? And gasoline futures are down, which is kind of good news. I mean, that's good news on the inflation front. So I think the market's going to struggle until it's pretty clear that inflation has peaked, and so that's the big thing. I saw a survey yesterday of some kind of, I'd never heard of the name of who does this, but it was a survey about like what, I guess it was a political survey of like what issues are Americans most concerned about, and inflation was like the number one issue, and then gas prices were like number two. And then it was about a dozen more, and something like climate change was, all the way down towards the bottom, and then, obviously, Ukraine and all these other like sort of, I guess you'd call them social issues, but political issues, I don't know. But anyway, inflation's number one concern, and that affects every single American every day. So. But my point is that the Fed. Funny thing about the Fed is that a lot of times, I mean, we should all know this. They say one thing and do something else, or they're adamant about a certain thing, and then lo and behold, they change their mind. And so they have done that so many times and for so long and they're worried about their credibility, right? I mean, they spent 6 months telling everybody inflation was transitory and it was temporary and this and that, and then they changed their mind on that. And I mean, I don't even want to go down the road of talking about all the stuff that the Fed has said in the past. And you might recall, back in, what year was it? 2018, I think. They had these grandiose plans for reducing their balance sheet and getting off of zero interest rates and all that. And then, the first sign of weakness, they abandoned all that. So, and then obviously when the pandemic broke out, they immediately reduced. They had an emergency rate cut rates to zero, and and started QE and threw trillions of dollars at that. And so it's no it's no great mystery when you double the money supply that inflation's bound to result from that. I mean, that's as that's as old as economics, right? And so I don't know what they thought was going to happen, but anyway, all that aside, the market itself is by no means out of the woods, right? And every time so far this year, every time that we've gotten a rally off of one of these lows, it's easy to think that okay, the lows are in and we can start to rebuild from here, and then another shoe drops, and so I kind of in my mind, I kind of like to think, well, maybe we can start the process of rebuilding from here. But in the back of my mind, I keep thinking that, in this sort of environment, it's very likely there is other shoes to drop, right? Um, yeah, and so I mean, we've experienced that. Like especially this rally in May here. This rally in May, I mean, had all the sort of makings of it had all the makings of, a rally that was going to at least, bring this thing back up into the area below this primary trend line, and then the waterfall sell off, right? And so everything can kind of go along fine, and then a problem crops up, and they just sell it right back off. So anyway, long story short, you know, first, before everybody gets too excited, I think that this market's going to need time to rally back up, maybe to the underside of this. But hey, look out. I mean, look out below. There's every possibility that something crops up. So, I guess it's everything's perception. Is the Fed going to raise 50 or 75 basis points in July? That's up in the air. Um, what are the inflation numbers going to look like? It wouldn't surprise me. I think that's another big debate. Inflation, what was it like 8.6 and then 8.3 or something, and so maybe it comes down to the next inflation number comes out to like it's 7 point something, and everybody can get excited and say inflation's peaked or whatever. But the thing about inflation is what's so insidious about it is what they're measuring is the rate of change. And so when the rate of change of inflation comes down, that doesn't mean that they're lowering prices at the store. Right? I mean, see, that's what the point that people miss and that you don't hear talked about very often is like, the prices that went up a lot of all this stuff that we buy, those are typically sticky, right? Like it's going to stick at the high prices. If the inflation rate comes down, that just means that they're not going to raise the price, as fast or as much as they have been. And so something I see that every time you go to the grocery store, you see this. Something you were paying $2.29 for is $2.79, and something you were paying $2.79 for is $3.49 or whatever. And I mean everything that I typically buy at the grocery store. I go there, once or twice a week, sometimes, once a week, but literally every time I go there, I see these price increases, and that's been going on for a long time. I mean, the Fed pretended that there was no inflation for years as I watched the price of most of the stuff that I buy on a regular basis go up. And so but anyway, they let the genie out of the bottle, and now it's going to be difficult to put it back in because, as I've said before, everybody knows this, that the only way that you get prices back down is by killing off demand, which is basically a recession. And so, I mean, I'm not saying anything that everybody doesn't already know. As far as the market goes, could be. I'm feeling a little bit optimistic, sort of. Just based on some of the stocks that let's look at ARK. Just a little bit of a rotation here. Yeah, so check this out. And I mean, this doesn't mean that this doesn't mean that, we're back in bull market mode, but at the same time, look at this sideways sort of consolidation here. You're starting to see in some tech stocks and some of those momentum stocks. It's interesting to, like, if I want to go back to the peak here, you gotta really stretch back. And so, here you got, this thing was over 150 bucks, and then it was, down in the 40s or whatever. And so this is what I'm talking about as far as like the dot-com days. Some of these things, I don't know about this since it's an ETF, right? If this was, a random individual stock, and there's lots of them out there, there's ones that are worse than this, I would say that it probably never coming back to the highs. And there's a lot of stocks that I don't think will ever hit the highs. I'll show you one in a minute. But anyway, people are seeing, signs of a potential bottom and rally, and yeah, I mean, as much as this thing sold down, from 160 to 40, and then of course, like this little sell off here from April to these lows, the thing, lost almost half its value again after there's a lot of stocks out there, they've lost half their value and then lost half their value again, right? And so there is the potential for some rallies in some of these things, like let's see, Coinbase. Coinbase is one that, kind of had like, well, it's got like a little pivot low pattern here, and then you had a long range day yesterday, and it's kind of floundering today. And this low back here after that sell off. So, I mean, you can kind of see a potential bottoming pattern here. This is another one that, there's tons of overhead resistance that these things have got to chew through. And so maybe a short covering rally or some genuine buying by institutions can turn these things around. But in the big scheme of things, for this thing to go to, there's probably a lot of trapped holders in here, somewhere in the neighborhood of 300 to 350, and whether they'll ever see, this one might have some potential. I don't know. I'm not a huge fan of all that crypto stuff, but anyway, this is the kind of thing where Wall Street did a lot of hoodwinking. Speaking of hoodwinked a lot of people thinking that, some of these stocks were the next great thing. Yeah, this one's kind of crazy. I mean, it IPO'd just around 40 or whatever, and so first couple days it was around 40, and then there was like this super spike, right, to over 80. But now, the over and under on this thing's $10, and so I mean, and it's coming up on a year. I think it was like right at the very end of July this IPO'd, and so anyway, for it to, I'd say that, well, I don't know. I mean, I don't know. I would say that the majority of holders are probably, who knows what the average cost basis is, but it could be somewhere around 40, say, because that's where it was trading before it started, selling off. And of course, it already lost half its value it was down 50% roughly IPO'd at 40 at the beginning of this year, right? Zoom back a little bit, and so started the year at about $20, and I mean, look at this. What was that, like $7 or something at the lows? So, but anyway, so I look at this chart too, and I'm like, okay, well, this is kind of, if I didn't know what this was, and I was only looking at, if I was only looking at like this part of the chart, I'd say, well, wow, this is actually probably looks like it has some potential here for a rally back up into this pattern and forming a cup. And of course, there's a bunch of overhead resistance, right around 10, but there's some potential here. Um, and so here's the one I was mentioning before, Peloton, right? Um, this reminds me of, like, this is what the dot-com bubble looked like. Sort of. I mean, obviously, like if you look at a weekly chart of the dot-com bubble, but a lot of the dot-com stocks over time, um, they took on this sort of look where basically, they went just absolutely nuts. It was kind of a mania type thing, and everyone rationalized, why these stocks were worth whatever it was they were worth. And then you get something that sort of turns sentiment around. You get that first sort of crazy, after a crazy run up, then you give it back, and then out over time. This is not really the Eiffel Tower pattern, but in a way it sort of is. Like if I switch this to a weekly chart, yeah. And so, but here's my point: is you got to be really careful. And I mean, one of the short-termism, I would guess you could call it, of a lot of these talking heads on CNBC, and that, um, no one's held accountable for this, because believe me, this was a hyped up stock and a momentum stock, and everybody could rationalize why it was so great. And I mean, they talked about it, and me being a sort of a skeptic on stuff like that, been around for a while. Yeah, I mean, to me, it's an exercise bike, right? And sure, it's cool. I remember those old exercise bikes with the fan blades or whatever, and so they strap an iPad on it, and somebody yells at you while you're doing it. But yeah, I'd like to jump on my bike and ride around the neighborhood outside. So, but anyway, somebody remind me when Peloton hits a new all-time high. I'd go out on a limb and say that it's not going to happen, anytime soon, obviously. And so these are the type of, and I mean, there's a lot of these things out there. I'm not going to try and pull them all up, but I think you get the idea. So, and back in the dot-com days, I mean, a lot of them, they got acquired or they merged with somebody else, or I don't know what happened to them, but there's a you know 15 years ago, 20 years ago, I was familiar with most of the stocks that were trading. I mean, I really watched the tape closely and kind of followed, hundreds of stocks, and now there's been so many IPOs. There were so many IPOs over the past few years that I've lost track of lots of them, and which is probably good, because there's been so many IPOs that and speaking of, and not even along those lines, but speaking of like dot-com mania, here's a good one. Zillow, right? I mean, Zillow's kind of got that dot-com mania pattern. So, if there's anything positive, one of the positive things is that a lot of stocks have already completed their sort of dot-com implosion. And so that leaves me wondering, whether the indexes themselves are ever going to have, the reflect like the actual implosion of, I would say a third of stocks have just absolutely been decimated. Yeah, maybe 25, 30% or something. But anyhow, so there's another good example. And so this becomes something to think about. When these stocks go parabolic, and so like that was the run up, the dot-com mania, and then that's the result. And anybody that thinks that something like this is just going to turn around, and so then it becomes about your cost basis, right? Like if you bought, and I definitely wouldn't recommend buying this anytime soon, but just to sort of prove a point here is like if you didn't own this, if you didn't even know what this stock was and you didn't own it or whatever, and so um, if you looked at this and said, well, hey, this is a classic, technical pattern here, and if this thing can break out of here and break over these previous highs, then so I mean, yeah, this stock could over a longer period of time, and that's assuming that these lows hold, right? Like if these lows from a few weeks back, if they don't hold, all bets are off. But something like this could theoretically be traded. Um, I wouldn't recommend it. I mean, I'd recommend maybe finding something similar that's got a little bit more behind it. Of course, I don't know the fundamentals of this, but anyhow, I think you get my point. So, but to expect this thing to ever trade some of the cost basis that some of these institutions must have on some of these stocks are, I mean, obviously someone out there is holding this stock, say, over 125. Now, the problem with averaging down is that typically when someone likes the story, right? And I guarantee if you went back in time and somewhere between July of 2020 and the July of 2020 or the middle of this peak here, there was probably lots of bullish analysts and write-ups and reasons why this was a great stock. Which brings me to my main point. A great stock, a good stock, is one that's trading above your cost basis, right? It's as simple as that. So, I mean, a stock is just a stock. It's a set of letters. And when you look at, technical analysis and you look at things objectively, which a lot of people lose sight of these days, objectivity. But thing of it is that if you look at it objectively, it's just a ticker symbol. It's just, numbers on a screen. It's just a stock. It's just a chart. And if you look at it that way, then, if your cost basis is $30, or $32 and it's trading above that, hey, it's a good stock. And then if it breaks out here and manages to rally up to 40, 45, or, if the trend changes, put it that way. And you can see it's running into some resistance right here, right? Acted like it's formed a little cup, high or low, and so it's acting like, it wants to do something here, but it remains to be seen whether, just like back over here, I could adjust this trend line across these highs, and then it broke it right here, and boy, it looked like it was off to the races here, but it wasn't. Right, and so from around 40 to down below 30 that's a pretty rough percentage ride, and so everything obviously is about cost basis. And I get the feeling that a lot of these Wall Street people they want to it seems like they're just half of the market nowadays, and half of market commentary is just people talking their book, right? I mean, these guys come on CNBC and they're like, "Oh yeah, well, this and that and this and that, but we have some stocks that we really think are great for these reasons and that," and then they rattle off the stocks that they're holding in hopes that other people might say, "Oh yeah, hey, that sounds great." So, all right, real quick, we got to open trade in this JO, and it's just like trapped in this sideways 60 to 65 area. Still a decent pattern, right? Still a decent pattern. We have not had hardly any open trades this year. We had this MP. This thing got knocked off the list. Like finally, back over here in May, I guess it was May and the beginning of June, had a decent looking little sort of swing trade set up, and came close to triggering in over here. The idea being that they sell down they make a bottom, they start to recover, and then, a lot of time, like back over here, huge big sell down, and then huge recovery, new highs. But anyway, so this had been on the pending list since May, and then finally, it stayed on the list even through this last little sort of sell down because it managed to sort of hold these lows, but yesterday it just broke below them, and so the system just deleted them. So got a couple other, real quick, go over this. This MOS is still dropping, and so, but at the same time, the idea is that we're isolating these stocks well ahead of time with the idea that eventually there's the possibility that they'll make a turnaround and recover, right? Because this thing's sitting kind of like right on resistance here. But anyway, so yeah, and of course you could poke down below there for a minute or whatever and turn back around, but there's some potential here. And I'm also, I'm starting to see some potential in some of these energy stocks, but boy, have they been decimated. Oh, and so, like this PSX, this is a very similar sort of thing. This is the first energy stock to hit the system. Now that's, unfortunately, things like this aren't always perfect, right? I mean, I can draw a lot of trend lines on a chart that get broken, and that doesn't mean it's all over. So, but yeah, that's kind of, this thing popped on the list fairly recently, but that's not a good sign. However, if it's able to sort of bottom out here and get back above that trend line, all is not lost. So we'll have to see on that. But yeah, I mean, basically the trend on this is still up as long as it still makes a higher low here. Now, if it starts to break below any of these prior lows, then the system will drop it. But as of right now, it's still a series, over a long period of time, it's still a series of higher lows. It just so happens that these energy stocks are getting hammered. So I got a list of a few of them here. I mean, just off the top of my head, let's see. I got this on my watch list, NBR. Look at that. Wow. I mean, just decimated. Occidental Petroleum, Warren Buffett. This is one Warren Buffett's been buying. This thing's holding up pretty good because of the old Warren Buffett thing. And I think my chart might have just defaulted. No, it's not on log scale. A lot of these charts, like, all of a sudden have been popping up on log scale, which is kind of throws me off a little bit. But so this one's been holding up pretty good. Let's see, ConocoPhillips. Yes, ConocoPhillips always kind of has been one of the favorites. Look at how some of these things are falling, and percentage-wise, that's what I was talking about earlier. So look at XOP, right? So yeah, let's look at the ETFs real quick. So the energy sector was, as of yesterday, was the only sector that was S&P sector, I think they said was positive year to date or something like that, and so still. But I mean, these sell downs that have happened over the last, not even a month are just amazing. So it's like, the old thing where the last one standing is finally taken out to the woods. I mean, look at that. That is just crazy, I mean, this OIH, I can't even tell what. So it was, maybe close to 320, and now it's at 200. And so do the math on that. And we're talking, since all, mid-June. So in like a month, these things are down significantly. Let's look at XLE. Right, XLE, same sort of thing. And the other thing to notice is that they've lost. They've lost these other prior lows here. So, and then of course you got commodities, right? Like copper. And so this is an extraordinary chart. This FCX here. Look at this. Um, Let me go back. There we go. Got to get the pandemic in there, right? Just for a little perspective. So there's the pandemic sell-off, and then boy, this thing, just amazing. I mean, the move on this thing, the pandemic low on this was $5, and it was a 10 bagger to 50, and which is kind of incredible in and of itself. The fact that I mean, it's kind of a proxy for copper, I guess you'd say. When I think of Freeport-McMoRan, I think of copper, and obviously a bunch of other metals, but I mean, just this is the kind of craziness that we're been experiencing. When I say this is anything but a typical market, you from the pandemic low to the recent highs, the thing went up 10 times from 5 to 50, and then you turn around and in the span of a few months, it's lost half its value. It's probably down close to 50%. Based on the highs and where it is now. So that's just crazy. And so you gotta wonder. You gotta wonder about. I wonder about institutions and their cost basis on a lot of these stocks that have this crazy price action, right? I mean, I suppose, and so that brings me back to basically my whole point here. The big takeaway from this is, and you never hear anybody really talk about this, is the fact that no matter what stock you're talking about, it doesn't matter, anything about the stock. What the most important thing is, is what is your cost basis, right? So I'm gonna do a little. Whoops! Oh boy, screwed that up, didn't I? I wanted to do a little experiment here. I just want to do something. I don't think this actually is probably not going to work. Oh well. It was going to be fun, but I don't think I can do a mystery chart thing. I'll try and figure out how I can do a mystery chart, but here's what I was going to do. Just for the fun of it, last thing to look at was going to be Berkshire Hathaway. Like I wanted to pull this up as a mystery chart, but I couldn't get my screen to cooperate. I'd have to get rid of this, and I'd have to. But all right, so everybody always you see all these articles about invest like Warren Buffett or whatever. If you were going to let someone manage your money, right? And of course, they have the this is the A shares, and of course they have the B shares, but if you were going to let someone invest your money, it might as well be Warren Buffett himself, right? And Charlie Munger. And so it's always kind of just like ARK is sort of what I like to call well, it's on the tip of my tongue. I'm going to lose my train of thought here. ARKK is like a bellwether for the high tech momentum, new innovation stocks and all that stuff. And so we look at the chart almost every week on the show here to see what ARK is doing. And so you could do the same thing with Berkshire Hathaway. You could say, okay, Berkshire Hathaway is a proxy for active management, I guess you could say, as opposed to just buying the S&P and the Qs and the Dow, right? I mean, you could, in theory, you could take a portfolio and split it into quarters and buy the SPY, the IWM, the QQQ, and the DIA, and you could dollar cost average into it over years, or you could, there's the old 60-40 bond port. I mean, there's lots of different ways that you can kind of passively invest, I would say, in the market, and obviously over time. But this is basically a good proxy for active management, because I wouldn't say that Berkshire Hathaway is like actively manage like a lot of these other funds or whatever, but I'm getting away from my point here. Here's my point is you look at this and you sort of look at this pattern and boy, it's a lot smoother and less seems a lot less volatile than a lot of the other stuff you look at. But so I was going to bring this up as a mystery chart, and that didn't quite work out. But just look at where this thing is. See, that was sort of my point here is this is a proxy for something. I'm not sure what, but you can see that, had that big runoff. And the most interesting thing about, and there's a few interesting things about this, but the rest of the market peaked at the beginning of the year, right? I mean, we know the S&P, at the beginning of 2022, that's when it started tanking, but look at that. So what I surmise here, what I gather is that this is the result of his energy investments, right? And so he's still buying OXY. And so you look at this chart here and you think, okay, well, where's this going, right? Where is this thing going? And it's pretty clear, like this level, this last little rally, this level here, if it's gonna make like a little W pattern and rally back, and then of course there's the trend line we can draw across the highs. So it's just fun to look at. And then there's the you can look at the B shares too. This is more like a regular stock. And so anyway, I was going to pull this up and say, hey, can you guess what this is? Right? It's Berkshire Hathaway. And so, the percentage drawdown from the highs, let's see here. Fortunately, there's some cool stuff on these charts that will actually let you relatively easily, there we go. Yeah, so how much, and this is not year to date or anything, this is off the highs. So Berkshire Hathaway, was down 25% from the highs, which roughly matches the S&P. The timing's just a little bit different. And so you can see that, even Warren Buffett's going to take drawdowns in a tough market. And so it is what it is, but it's a fun chart to look at anyway. So there's a couple of pending trades. There's an open trade. Theoretically, there's a bunch of potentials setting up. That I do see. So we're not really designed to like bottom fish in stocks that have been absolutely destroyed and show signs of maybe rallying up. There's lots of those. But what I will say is that when I look around and the other thing that I wanted to mention real quick is well, let's take U.S. Steel for instance. All right, so you guys remember back over here, like back in May, back here, there we go. This was a potential. This was a pending swing trade setup, right? It had all the sort of hallmarks of a decent swing trade, right? Like, longer term uptrend, little sell down, much higher low, consolidation starting to turn back up. You can't see it on the chart, but I got look at that RSI there, right? So anyway, yeah, here's one that it started to look sort of attractive, over here, and it never triggered in, right? Just never triggered in and dropped. And there's been a whole bunch of them like that. And so you can see that there was still some potential. It was still kind of hanging on, and then just dropped out, broke below this low, just destroyed. And obviously just dropped off the list and was no longer a swing trade. There's been a whole bunch of those this year. And so if anything, I mean, we've managed to avoid most of the carnage. And the problem now is that, some of these stocks like this, if it catches a little bit of a bid, and goes from, 16 back to 20 or something, I mean, that percentage-wise, there's a lot of, really good potential trade setups on stocks that have just been decimated and beaten down, right? But I mean, if you look at something like this, and the other thing about this is like you don't want to. This is amazing to me, right? Like, look, that's another thing. At the end of June, I looked through a bunch of monthly charts, and some of them are real eye openers. This is, just an example. I encourage you to look through monthly charts because you go back and you'll see stocks that have never gone back to their 2000 highs, like the 2000, the dot-com implosion in 2000. You see stocks that have never gone back there, but this is like kind of what I was talking about. Say something like a Peloton, right? I mean, there was a period of time where it had its day, and look at this, right? I mean, look at the time frame on this. You think this thing's ever going back to 175? Jeez, I don't know. Um, Here's a good example, GE. This is always my favorite example, and I know that I usually don't do these shows this long, but I'll leave you with this, right? What I said before, the big takeaway from this show is a good stock is one that's trading higher than your cost basis. And so, you know, I can guarantee you that there's somewhere out there, there's a long-term investor that, at some point, I mean, everybody, GE, at one point, like back in 2000, GE was like the poster child for, what's unusual about it is during the dot-com bubble, right, GE was like probably one of the number one blue chip stocks. I don't know if people still call them blue chips or not, but GE was a blue chip stock, and there's probably someone out there, heck, there could be quite a few people out there that are holding this blue chip stock through all of this, and here we are 22 years later. There was a couple of rallies that these were obviously good opportunities to throw in the towel. I don't know who's still holding GE from 250. There might be somebody. That would be pretty rare, wouldn't it? Maybe somebody's got a stock certificate hanging on their wall. But anyway, this is just a really good, print this out and hang it on your wall. And this is not some Peloton either. This is not, this is not a dating app. This is not BuzzFeed that went public via SPAC. This is not LegalZoom or some biotech startup. I mean, this is GE aircraft engines and power generation. And I mean, this is real business. I would, medical device. I mean, on and on and on. So anyhow, long story short is, you just look at this chart and you realize that, hey, there's no guarantees that, that that a stock is going to ever return to its former glory. Right? And so there's been some crazy ups and downs in this particular stock here. This is a monthly chart, but I mean, Intel is another one too. I mean, Intel peaked over here in early 2000, and it literally took until, well, let's see if I can even get it on the chart here. Well, it took until 20 years to get back to 20 years to get back to where it peaked in 2000. Or no, I'm sorry. Hang on, 18 years. Yeah. So it peaked in 2000, early 2000, and then finally in early 2018, it managed to get back to those highs. But look where it is now, right? So imagine holding this thing for Intel. And again, this is not Peloton or one of these SPACs or whatever. And so I mean, this just goes to show that no matter what, And so consequently, this basing period here, right? Monthly charts are fascinating, right? I mean, years of basing from 2001, basically from back here, right? From the beginning of 2001, and then it finally, like right here in 2014, so 13 years later, it broke out of, a 13-year long base and then had a pretty substantial move, 20 to 60, it tripled, but look at where it is now. So, um, a good stock is one that's trading above your cost basis. And so I'll leave you with that. And hopefully we can find some decent, trade setups in the very near future that will head in the right direction, and we'll see what happens. So real quick, one more look at the SPY. Yeah, I mean, there's only so much to talk about. It's not like we got a whole bunch of open trades that we can analyze and look at and that. But I will say that there's quite a few potentials. So I will see you guys back here next week. Thanks for tuning in.